And welcome. It is Tuesday, 6 p.m., which means it is time for Tax Sherpa live office hours. So this is our weekly Q&A. Usually it's Q&A. Today it's going to be Q&A. Sometimes I'll do more structured stuff. I did a little bit of a presentation style thing last week, but overall, this is where we answer questions that come in all over the place. So, we get questions from email, we get questions in person, we get questions from clients when we're talking on phone calls. So this is where we can kind of condense all that and make that available to everybody. So welcome everybody. I'm Neal, founder and chief tax strategist here at Tax Sherpa. We got Serena on the line,
Hello,
and
hello.
that's just a lawyer thing I went to today, got a card for an estate planner here in Georgia. Everybody should do estate planning, including myself. So that's that's not a question or an answer, it's just a tip. Um, but yeah, so before we dive into the actual questions, I'll give you a little bit of a preview. This is me. This is my story. I'm actually getting new pictures done this week, so this will change. But so I got nasty letters from the IRS saying I owed them $1.3 million, and that's how I got into the tax world, through my own problems. And over the last 15 years, I've worked on over 50,000 tax returns, and saving clients millions of dollars a year. And so back in technically 2019, but really got started in 2020, started Tax Sherpa. And my mission is actually evolving. So I've had this realization, and Serena, I haven't even told you this. I've had this realization over this past week or so that, you know, yes, we aim to serve our tribe, and that is the solopreneurs, the small business people, the freelancers, the independent contractors, basically the people like me who either can't or won't get a job, and help save them giant amounts of money on their taxes. That is definitely thing number one. Thing number two, I'm coming to the realization is that not everybody is going to be a client, and that's okay. But what I want to do is I want to use technology and the tools that we are developing in order to help people keep as much money in their pockets as possible and away from the government as possible. And so, that's something that we can deliver to, the country at scale that, we can't do one-on-one services for. So that's sort of the long-term version of things. You know, Obviously our clients come first, but we want to do as much good as we can because to me, handing a dollar over to the government is not a good thing. Not for you, not for them, not for the world. So I'm all about defunding the government. And if that scares you, this is probably not the show for you. So, uh, but speaking of, the quality of our questions determines the quality of our life. I love this quote because I think it's really true. So, got to ask the right questions. And to me, there's multiple ways of looking at the tax question. One way to look at it is, what's the root problem with overpaying? So, in the way the tax code is written, you can pay more than you owe. It's an option. You can actually go to the Treasury and donate money, and there's nothing legally wrong with that. It's perfectly within your rights to do. But I think it is the wrong thing to do, and the reason why I think it's the wrong thing to do is because it's wasting 20% of your life, and 20% is an average. So if you combine all the different taxes, right? There's income tax, federal and state. There's payroll taxes. There's self-employment taxes. There's additional Medicaid taxes, and that's not even including all like the sales tax. If you take all that and if you average that all out, and you're paying 35%, which is a very common number that we see, and we take you down to 15%, well, that's a 20% difference, right? What does that 20% actually represent? Those are days that you went to work and you did your thing, whatever that might be. You came home, you took all the money you earned that day by providing value to others, and then you hand that money over to the government in the form of taxes. And to me, that is a waste. And 20% of a year is 74 days. So it is a literal waste of your life. And I mean that in every sense of the word. If you're overpaying on your taxes, you're wasting that time that you spent doing all those things. So I want you to live your best life possible, and that means having control over your time as much as possible. Obviously, there are, uh, we do exist within the legal framework that we live in, so we got to follow that because nobody wants to go to jail over this. But within that boundary, there's a lot of things you can do, and we want to make sure that we are taking as much advantage of that as possible. So, with that said, so that's my question, and I have the answer to all other questions. And the answer to all other questions is it depends. So I was at this seminar today on estate planning given by a local estate planning attorney here, and he actually used the same line. He's like, "I'm going to give you the lawyer answer. It depends." When somebody asks a question, so I chuckled. But yeah, that's the basic idea. And people always ask me like, "Well, what does it depend on?" I said, "Well, it depends on the facts and the circumstances, because what is true for you might not be true for somebody else. Even though the actions might be identical, the intent behind them and how they're treated for tax purposes might be different." So, uh, for example, let's say, uh, well, no, I'm not going to use that example. $100 shows up in your bank account. How is that taxed? I don't know. Depends on what it is, right?
Right, right.
If it's a loan, it's not taxed. If it's a repayment of like a reimbursement, it's not taxed. If it is a gift, it's not taxed. If it is a capital gain, a long-term capital gain, it is going to be taxed potentially, depending on the total income for the year and what else is going on. If it's a short-term capital gain, then it will be taxed at ordinary rates, which might have, depending on the other things going on in the year, is going to possibly be taxed depending on like the rates that you're paying. If it's wage income, it's definitely going to be taxed, at least at the payroll level. And yeah, so it depends. And with that, let's go into the um, let's go into this week's questions. What do we got, Serena?
So we have a question about the BOI form.
Yes.
So, so a client asks, can you explain why the new BOI reporting requirements have been introduced
Yeah.
and what the government aims to achieve with it? What's the
Yes.
purpose?
So this was part of a larger piece of legislation. So I actually wrote a couple blog posts about this back in the beginning of the year, but things have changed since then. So Congress passed this law. It's one of these laws that includes a whole bunch of things. As part of that was the Corporate Transparency Act, and this had been sitting in Congress for a couple of years, and they finally got it passed. So what it says, what the law says, is that there needs to be a federal agency, and they decided to use FinCEN, which is the Financial Crimes Enforcement Network. Um, there needs to be a federal agency that has information on basically every corporate entity. There's a couple exceptions, but doesn't apply to pretty much everybody. So big companies are exempt, banks are exempt, insurance companies are exempt, but like small companies, like you and me kind of companies, are not exempt. So they created this database thing where you would have to upload information to the federal government about the beneficial owner. So beneficial owner means that who's the ultimate beneficiary. And anybody who's a 25% or more beneficiary of an entity has to be included in this report. So this went into effect January 1st, 2024. All companies that existed December 31st, 2023 and prior were given until the end of 2024, which we're coming up on a couple months, to get their initial report in. And then if you if the ownership structure remains the same, you don't have to make any further reports. If there's a change in ownership so this 25% ownership thing changes, then you have to, I think you have 30 or 60 days in order to get that updated report into the government. For companies that were formed in 2024, you were given 90 days from the date of formation in order to get this initial report in. And from 2025 going forward, you have 30 days to get your initial report in. And the ostensible explanation for the need for this is for, it's the usual, excuses. It's money laundering and terrorism financing. So that's the reason why they've created this whole new bureaucracy. If you go to the Tax Sherpa blog back at the beginning of the year, you can actually find some videos of me actually going through the form and how you fill it out and everything. Um, it's not super complicated. You just kind of list everybody, and you have to upload like driver's licenses and stuff. Um, so they just want to know. So a couple problems with that. So problem number one is that if you're going after people who are engaged in money laundering or terror financing or whatever, do you think they're going to fill out the form? I kind of think no. So on the face of it, that doesn't make any sense. The second thing that bothers me about it is that they already have this information. It's just not in one place, right? So when you register with the state to make a new LLC, you tell them who the organizer is. Every state has a slightly different process, but you tell them who it is. When you apply for the tax ID number, you say who's applying. They have to have a social security number. And so there's a responsible party that is there in the IRS databases. So it's in these different places. And then obviously the like if you have a driver's license, the state, depending on what state you're in, Department of Motor Vehicles or MVA or different called slightly different things in different states. But all these things are there already, right? So what they wanted was just to take all that information instead of having to go to these other states and ask for this information and get a warrant or whatever. They said, yeah, just give it to us and we'll keep it in one place. And by the way, make a giant security risk for that honeypot of information. So that was how we started the year. Then there was a coalition of small business owners that sued the federal government, and in March, the judge ruled that the the language of the CTA, the Corporate Transparency Act, is overbroad, and Congress doesn't have that authority to do that, and so he struck it down as unconstitutional. So that's where we are right now, and the Treasury Department, which is where all this stuff is headed under, has come out with this cockamamie explanation saying, "Oh, well, that ruling only applies to the people who were in that trade group that brought that suit." And there's like 50,000 small businesses that are in that coalition. And it's like, well, that's not how the Constitution works. Okay, granted, not a lawyer, so talk to your lawyer. But I read the decision, and from the way I read it, unconstitutional is just unconstitutional. You can't pick and choose who the Constitution applies to. That's just not how the system works. So, but what's happened in the past week, and I've gotten this myself in my own companies, is that I've gotten notices from the Secretary of State of Georgia and the Secretary of State of Florida, both with like emails saying, "Hey, you have to get your beneficial ownership information report in." And so the secretaries of state are going along with the feds on this one, at least so far. Trying to push this. So again, talk to your legal counsel, but the way it looks to me is that this is currently unenforceable. Now, I'm sure the government has said they will appeal. I don't know the current status of that appeal, if they've even actually filed it or not, but it is an evolving area, and last I've seen is that struck down as unconstitutional. So, I mean, there's definitely options at that point. It's like, well, you can comply anyway, and just submit that as a proactive, preventative measure, or you could not, and you got to make your own business decisions. But that's the way the landscape looks to me. So, talk to your legal counsel, and um, but that's what it looks like from. It's not even though it's corporate related, there is no tax impact whatsoever. They just want your information. So there's no, the only thing you could view as a tax impact is that there are penalties if you don't do it, and it were upheld. So
Right.
a couple of hoops to jump through there. But yeah, go to the blog, and you can find the video on me walking through the form if you want to do it. If you don't, talk to your lawyer and see if that is justified or not. Um, at this point, I'm not particularly worried about it personally because of the judicial ruling at the moment. And if it changes, then it'll change. So.
Right. And then we can talk about like how these firms are also asking their clients to pay like $99 to fill out the form, knowing this just to
Yeah.
make money.
Well, yeah, I mean that is true. And,
Right,
and
right,
if we filled it out for a client, we'd probably charge the same.
right,
So
right. But only when you need to, right?
yeah.
Yeah,
So it's
understood.
I would say it's still to be determined until I don't know if they'll appeal it up to the Supreme Court or whatever, but the current federal judicial ruling is that it was struck down as unconstitutional.
Right. Understood. Alrighty. So we have a tax saving and planning question.
Uh-huh.
What's one of the deductions or credits you think most people overlook but can be very, very helpful on a tax return?
Yeah, the biggest one that's overlooked is the residential energy credit.
Okay.
Maybe not biggest, but most commonly overlooked. So the residential energy credit, there's different parts. So people have heard of the fact that, oh, if I get solar panels, then I get 30% back on my taxes. I don't know what's going on with my lighting. That my head's going transparent here, but so that's part one of the residential energy credit. There's a part two, and this was actually expanded by I think it was the Inflation Reduction Act. It was one of those, one of the Biden legislations, and what it is that they expanded the things that apply to the residential energy credit, and they made it renewable in the sense that the old credit was you had $500 of tax credit for the small stuff, for like energy efficient windows and appliances, and new energy efficient doors and things like that. But you had $500 lifetime. So once you used up the $500 credit, that was it. But now they've made it up to $2,500, and you can get that actually every year if you spent enough money on those things. And they expanded the pool of expenses that qualify. So you can get heat pumps, and you can get a lot of utility companies will actually come out and do an energy audit, and it'll say, "Oh, you've got leaks here, in your window trim, and you could do this, and you could change your lighting, and all this kind of stuff." And you can actually get tax credit for the amount that you pay for those kinds of things. So that's the most overlooked one. Um, I would say second most overlooked is actually the child care credit, which is for kids 12 and under. Uh, for daycare and after school and camps and all that kind of stuff. Uh, a couple caveats with that is that if there's uh, if there's two parents, if it's a married filing joint situation, both parents have to have earned income. Some people get confused by that. So if one parent works and one parent doesn't, then you're not going to qualify. If one parent works and the other parent works, but not for earned income, so it gets like profit distributions and things like that, also not going to qualify. Um, those are the most commonly overlooked. They're not the biggest though. So in terms of the biggest, there are strategies out there that are you know that can wipe out your taxes entirely. Now they come with price tags, so
Right.
it's not quite as sexy as it sounds. But generally, if you're a high income person, say 250 and above of income, then there's all kinds of strategies that open up to you. There's charitable giving strategies, and then there's business ownership strategies, and a whole bunch of other things. You have tax credits. So right now, the big hotness in the tax professional world is the solar credits. A lot of companies have created solar projects that sell the tax credits for those. Um, so it's a constantly evolving space. But I saw one last year where it was sort of like a conservation easement, but it was with artwork, where it's like we're going to buy this artwork and then we're going to donate it to the museum and we're going to leverage up. And yeah, so the key with all those things is that in order to get um, a bigger benefit than the cost of whatever it takes to get into these programs, is that you're going to use leverage in some way, and it's going to be leverage in the sense that could come back and cause you economic damage later on, and that's actually the justification for the value that you are either giving away or losing or what have you in the economic sense. So there has to be real market risk associated with those things. So that's just something to keep in mind when you are looking at some of these more advanced tax strategies. And it's beyond the scope of what we get into here. Of just kind of a quick question and answer. But yeah, there's big strategies out there, and if you are in the high income brackets, basically the short version is they'll cut your taxes in half. Depending on the particular program, they'll they'll take you from when you take federal and state, you might be paying 40%, maybe 50% if you're in California, and they'll take you down to 20%. And that 20% is actually not tax, but it's not, but it's incorporates the fees that are involved in developing these different tax strategies. So, but that's kind of like rough numbers. If let's say I make 500 grand, so my tax bill's, I don't know, 125,000, then after all said and done, my net out of pocket will be 60. So it went from 125 to 60. I cut my tax bill in half, even though it's not tax at that point. It becomes this combination of tax uh, and purchases and fees of different things. But to my mind, doesn't really matter. It's how much is out of my pocket, right?
Mm.
So those are not so much overlooked as they are unknown. Uh, so that's just kind of two different ends of the spectrum. One is small stuff that's overlooked all the time, and there's big stuff that is unknown and people don't know how to apply. Uh, so I'm trying to think of something in the middle. Well, the things in the middle are for the business owners. If you have whether it's your main thing or if it's a side business, implementing the tax advantage cash flow strategies, like the summit strategy sessions or the accountable reimbursement plan, all those kinds of things, in order to capture cash flow without having to pay tax on it. So those are both big, not as big as the things that cost tons of money, uh, but they're big and they are overlooked. So yeah, that'll be the ones in the middle.
Looks like we have a cost seg question.
Okay.
So someone wants to know, they want to do a cost seg,
Okay.
right?
Yep.
They want to know your process. Well, first, if you do them, right?
Yep.
If you provide that service,
We
what's your
do.
process? And do you have to be at my property to get this done?
I don't have to be here. No. So
Okay.
so we do help clients with cost segregation. Some of them, and depending on the client, this kind of varies. Some of them would just say, "Hey, go get this done," and they go do it. Other ones say, they want us to do it. Fine, we'll take care of it. In some cases, so well, first let's define what cost segregation is. So
Mhm.
cost segregation is the process of taking a piece of real estate. It could be other things, but usually it's real estate, and segregating the asset into different classes, because this is a depreciation question. So you buy a house for, pick a number, $500,000, and what did you actually buy? Most people say, I bought a house, but that's not actually true. If it's a single family residential house, and it's sitting on a piece of land, you bought some land, you bought probably a driveway, you maybe bought a garage, you probably bought some landscaping and some walkways, maybe a fence. Then there's the actual structure, and there might be two structures, depending on what else is going on. I got a little gazebo thing in the house that I bought out back, which is falling down, but that's a separate thing. Um, and then in the property or in the structure itself, there's all kinds of other stuff. There's wiring, there's ceiling fans, there's flooring, and there's cabinetry. It's like all the different stuff that goes into a house, right? And that's just a residential house. In commercial, it becomes more complex. So all of those different things have what is called in the tax world, it's called different depreciable lives, meaning that, okay, this is a capital asset. How long of a period of time does this thing expect to last, and how much percentage do we take as an expense this current year? And so uh, when we're talking real estate, usually there's four classes of lifetime that we talk about most frequently. So there's 5-year property, there's 15-year property, there's 27 and a half year property, and there's 39-year property. So residential real estate is 27 and a half, commercial real estate is 39. 5 and 15 are usually the improvements, or furniture and fixtures kind of stuff. And there's other classes. There's 3 year and 7 year and whatever. But those are the 5, 15, 27 and a half, 39 are the big four that we see most often. So what a cost segregation study does is an engineering firm will examine your property and then they will segregate all those different things. And they'll say, okay, the land is this, or maybe you tell them how much the land is. That varies depending on what system you're using. So land is this. Land is not depreciable because it doesn't degrade. It's just there. The landscaping is going to be, usually 15-year property. It's going to be that. The driveway, the hardscaping is going to be such amount. The appliance wiring, the cabinetry, the flooring, the ceiling fans, and all that kind of stuff is going to be all these different categories with all these different amounts. And so the real magic of doing that is that when you shorten the depreciable life, that means we're taking a bigger percentage of that cost each year. And then you layer in the concept of bonus depreciation. So bonus depreciation is a bonus, right? And the rules change year to year. So currently, because of the Tax Cut and Jobs Act, we are in the 60% bonus year, meaning that, let's say I bought a new refrigerator for $2,000. It's a capital asset. It's a 5 year life. And so I can't just expense it for $2,000. I've got to write it off over 5 years. But with bonus depreciation, I get 60% in year one. So $1,200 of that 2,000 I get as a first year deduction. Now, if there's a whole bunch of that, that makes for big deductions in year one, right? And usually when we see these reports, then the 15%, 20%, something like that of the total cost ends up being this shorter term stuff. And so if it's 20% and we're taking 60% of that 20% in year one, that creates a 12% deduction right now. So let's go back to our $500,000 property. And well, let me see it up on a calculator here, so that might be easier to follow. Calculator. All right, so we got $500,000, and we take 20% of that, as that ends up being what is in that short-term property. So we got 100 grand of the 500 is short-term stuff, and then 60% of that times 0.6 gives us a $60,000 depreciation deduction in the first year. So what that does is that takes $60,000 worth of depreciation that would have been spread out over 27 and a half years and brings it all up to this year right now. And obviously that increase in deduction is going to lower net income. And in the case of real estate, because of depreciation, real estate usually runs at a loss on a tax basis. Hopefully you're positive cash flow, but negative on tax. So if I bought this $500,000 property and I rented it out, well, maybe I made 5 grand worth of cash in my pocket, after all expenses, but on a tax basis, I'm now looking at a $55,000 loss. So by doing this strategy, it allows us to capture huge losses now, which is going to lower my overall income, and that's going to lower my taxes. With that said, how do we do this? So if the property is worth, I think they recently changed it. Basically, if it's residential property and it's under, last I saw was 600,000, but I think they raised it to 1.2 million. If it's residential property under that dollar limit, then there's an online tool you can use, and we've used it with clients. It's from KPKG. You go to kbkg.com, and you can do the residential cost segregation tool, and they'll charge you, it's like $500 for the report, and you put in a whole bunch of information and they'll give you a report. If you're not able to do one of those automated report tools, then you actually have to hire an engineering team to come out to your property and examine it and generate the report, and that's going to cost you 5-10 grand. If it's a big commercial property, maybe more, but for the typical properties that we see, it's usually in that range, $5,000 to $10,000. But if your property's in that range, then it's well worth doing, assuming that you can take advantage of the strategy in order to capture that big deduction up front and offset other income. So when we talk about cost segregation, people get all excited. There's
Mm.
there's caveats. Uh, so this only makes sense to do if you have other income. So if you're a pure real estate investor and on a tax basis you don't have any income, it's not worth doing because you're not saving anything, unless you just want to know, I guess. But the we've seen this happen a couple times where people get all excited and it's like, oh, I did this report and we're doing this. It's like, okay, doesn't help you any, but sure. Um, so you have to have other income that is creating taxable income that is creating tax in order for you to be able to use this strategy in order to offset that other income. Okay, because that deduction that we're generating it has to be deducted against something else, right? That makes sense. So that's thing number one. Thing number two is that if your real estate is passive, then it's not going to work. So what does passive mean? So passive means that you are not actively or materially participating, over the scope of the year in the working of the real estate. So by default, rental real estate is considered passive, and it is subject to what are called passive activity loss limits. So your PAL limits. And what it does is that it limits passive losses globally, to $25,000. And as you make above $100,000, that passive loss limit shrinks from 25 to 20 to 15 to 10 to 5 to 0 by the time you make $150,000. So if your total income, let's say you have a day job, you make $200,000, and you have $200,000 worth of real estate losses, and you're passive, you get zero of the $200,000 losses, and it carries forward to next year until either you sell the property or until your income is low enough for you to be able to use those losses, and you're below that limitation threshold. Okay, so how do you get around that? Well, you got to be active. And there's a couple different ways to be active. So, way number one to be active is to do short term rentals. Because if your average stay is under 7 days, then you are not in the rental business. You are in the hospitality business. And the code makes this distinction. So if your average stay for a property is under 7 days, then you're automatically active, and you don't have to do anything else. You check the box on the tax return, and then you're able to capture all those losses because they're not passive. So, way number two that you'll hear about is if you're a real estate professional. So, a real estate professional means that you spend at least 750 hours on real estate activities during the year, which averages out to be about 15 hours a week. And critical word, and that um, you spend at least 50% of your working time on these real estate activities. So if you have a day job, it's very hard to qualify for that because you're doing something. You have your day job for 8 hours a day, or whatever it is that you work. Where it does apply is if you're a full-time real estate agent or a mortgage broker or you work in construction or something like that. Uh, Important note, if you work a day job in those industries and you get a W-2, that does not count, because you have to be working for yourself. So you have to be an independent contractor or own your own business in those fields in order to count that towards real estate activities. Also, managing your own properties will count towards that 750 hours. So if you meet both of those tests, 750 hours and 50% of your time, then you're a real estate professional, and then all of your real estate activities convert from passive to active, and you're able to take those losses against your other income. Great. Way number three to be active is less than the professional. You can be materially participating if you spend at least 500 hours a year on your properties. So there's a distinction here in that real estate professional could be all different kinds of real estate activities. You could be mortgage brokering, you could be doing construction, you could be managing rentals, all this kind of stuff. Material participation with rentals, you're just dealing with the rentals. So you're just working on your portfolio. If you spend at least 500 hours a year, then you are materially participating. And we just had a case last week where a client had, what was it, 5 properties? I think it was 5. And
Yeah. Yeah.
yeah, so it was a married couple. husband works, wife does the real estate. So, and she spends the time. Great. Okay, so we were looking at their 2022 and 2023 tax returns, and unfortunately, we could not apply cost segregation to those years because there is an important election that you have to make on a return in those cases to treat all real estate activities as a single activity for the purposes of this qualification test. Because if you don't make that election, then you have to qualify for each property. And you can't spend 500 hours on 5 properties and, 2,500. There's not that many hours in the year, for in order to do that for each individual property. And with this particular election, and I'm trying to remember the code section, it's escaping me. I want to say 267K, something like that. Um, this particular election can only be done on original tax filings. You cannot make the election on amendment. So what we're going to have to do in this particular client's case is we're going to make the election in 24 and then do the cost segregation and um, capture those expenses there. So that's test number 3. It's the 500-hour test. Test number 4 is a weird one in that it is only 100 hours. So 100 is a lot easier to do than 500 hours. But you also have to be the single individual who spends the most time working on that property. And that one is actually harder because if there's any, maintenance work or anything, a lot of times those people spent more than over like 2 weeks, if there's a big renovation, than the owner did spent working on the property. So that was a little wonkier to qualify for, but we have had clients qualify for it in the past. In order to you know in order to prove all this stuff, you got to keep logs. So we have a log template that we have with clients to help them keep track of everything. And so like today is October 1st. I spent 3 hours working on this property, doing whatever it is I did. Dealing with contractors or whatever. And so should the IRS ask, and sometimes they will. This is an issue where they will sometimes ask. You got to be able to produce those logs, on demand, basically, and say, hey, here's why I'm active and not passive, and I am entitled to this deduction. And you might have to go back and forth with the IRS a bit in order to do that, but that is how the process works. Which is just a note on how tax returns work in general. So when you file a tax return, you are telling the government this is what happened this year for all these different activities. And the taxable impact of all these things combined is X. And my tax bill is whatever it is. And the government, through the IRS, takes that information, it compares it against what it all knows from third-party sources. So if somebody filed a W-2 or 1099 or whatever, with your Social Security number, they're going to match up whatever they can. And if all the third-party sources are covered, then most of the time they will take your word for whatever it is that you're saying happened through the tax return. So you're telling the story of your life for the year through the tax return in monetary terms. Now, on occasion, the government will say, well, yeah, you said this thing, I want to see some proof. And you have to be able to come up with that proof for whatever it is. And so, it's not all, but 95, 98% of like tax audits, which is what, them asking questions is, uh, really comes down to documentation. So, keep your logs, do your books, do all the things that you're supposed to be doing, and you will win. When they ask about things, if they ask about things, there are ways to do things more aggressively, less aggressively, safer, and more risky, and those kind of things. But overall, you told the government the tale of your life for the last year. You just have to be able to show the paperwork, substantiating all those things, and then you're fine. It's a hassle. I've definitely been through my share of things. That's how I got into the whole tax world. Mine was not an audit though. Mine was an SFR, a substitute for return, which is where I didn't file returns for a number of years, and after a couple of years, they'll take that third party information and they'll create a tax return for you. And if they run their numbers and they decide that you would have owed them money, you'll get a letter. That's what I got. If they run those numbers and they decide you would have gotten a refund, they'll never bother you. You won't get letters, you won't get anything. They'll just let it go. And if you wait too long, then you can't, beyond 3 years, then they won't even give you your refund, even if you do claim it. So we've got a client going through that right now. We're filing a 2020 return. It's like, yeah, it's too late. They were owed a refund of 5 grand, but not gonna matter. Anywho, so where were we on cost segregation?
Yeah, we're on the cost seg, but I
Okay.
do have a 1031 exchange question.
All right. Well, let me finish up cost seg.
Okay, okay, okay.
All right. So cost segregation, we segregate real estate properties into different classes so we can capture more deductions upfront. It's the same total over the lifespan, but it's more upfront, less in the end. And we take those deductions if and only if we can actually use them. And that means having other taxes creating or other income creating tax liability, and we can get past the passive activity loss limits. So both of those things have to work in order for cost segregation to be a viable strategy. If they do, which for a lot of real estate investors that have substantial portfolios, they do qualify. It's a really powerful strategy. So definitely worth investigating if that applies to you. So that's my 20 minutes on cost segregation there.
Well, it's a lot to say about the cost segregation report, so,
Yeah.
right? Just to understand the whole process. There's so many steps to
Yeah,
complete it, but it's worth it.
it is. Yeah.
Yeah. We took a guy from owing 50K to now he's what, getting a refund of 24K from just doing the cost segs and other strategies, right?
Yep. Yep.
Awesome, awesome. So 1031 question, client asks, how can I use a 1031 exchange to defer taxes when selling one of my rental properties and reinvesting in another?
Right. Well, that's perfect for 1031. So 1031 is a like kind exchange. Now, before the Trump tax reform, this applied to all different kinds of business assets. Tax Cut and Jobs Act gets passed, it's restricted to real estate. So we'll see, as the Tax Cut and Jobs Act expires in 2026, we'll see if that maintains that treatment or not. But for now, just applies to real estate and just applies to investment real estate. Cannot be used for real estate that you personally live in. But if you have one property, you sell that property, you take all the net investment from that property that you sold, you keep it working in the real estate market, and you buy another property, then you're able to do a like kind exchange. So the key element to the whole thing is that you did not personally receive anything to use on your lifestyle. So everything was kept working. Or I'll refine that a little bit in a second here. So um, so let's just say, I sold a $500,000 property. I take that $500,000. It's not, I don't even touch the money. It's held by a person called a 1031 intermediary. And there's, companies all over the country that handle these kind of transactions. They hold the property for you. Then you have a time window. I think it's 90 days to identify and then another 90 to close. So you have a time window and you say, okay, I have $500,000 sitting there. I'm going to go use that as a down payment on this bigger property over here. And they say, great. And, you arrange the closing with the title agent of your closing attorney, depending on your state. And, the 1031 intermediary will coordinate with the title agency or the closing attorney to, manage the funds and everything. So you never touch it. And, you get a loan or whatever other financing that you need in order to acquire the next property. And if you do all those things, then it is a tax-free transfer. Important notes. So one, the 1031 intermediary does not work for free. So they'll charge you, $2, $3, $4,000 typically on a regular size deal. Uh, Second thing is that any money that you do take out for personal benefit, that becomes taxable. And that's just, your regular capital gains kind of stuff. So you can do a kind of a mix and match. You could say, okay, I got 500 grand here. I'm going to take 100. I'm going to pay taxes on the 100, but then the 400 will carry forward into the new property. You can do that. The other thing to keep in mind is that your basis in the new property is the same as your basis in the old property. So people get confused by this all the time. So let's say that $500,000 property, let's say I bought it for 200, a decade ago. And so I sold it for 500, and then I took that 500 and put it as a down payment, and I now have a $2 million property. Okay? Again, I'm just making up numbers, but this is a kind of the typical thing that happens. My basis in the $2 million property is not 500,000, it's not 2 million, it's the 200,000 I originally bought the $500,000 property for. So, that basis carries forward into the future. So when you sell the $2 million property, you're not selling it. Let's say it goes to 3 million. You're not selling it 3 million against 2 million. You're selling it 3 million against 200,000. So your taxable gain just grows and grows and grows as you use the 1031 to scale up. So that that kind of makes people end up feeling trapped because well, trapped is probably a strong word, but it makes them feel that way because it's like, okay, I've done 2 or 3 or 4 1031 exchanges. Now my basis is effectively nothing compared to whatever my asset value is, which is great. But now if I sell this property, I got to take a huge tax hit, right? So the workaround is you don't sell. You keep 1031ing, you keep going, you keep going, you keep going, and you can pull out cash in refinances because you are taking loans that have to be paid back, and that is not taxable income. But you're never gonna capture the full value because nobody's gonna give you a loan on 100% of an investment property. Residential property that you live in, maybe, depending on market conditions. But for commercial property or investment property, no. Typically 75, 80% is the most people go. Sometimes you'll get 90%, again, depending on market conditions. So, so if you want that last 10, 20, 25%, then you're going to have to sell. And then you're going to be paying tax on 20, 25%. And so you kind of come out the same anyway. So, that's sort of the golden handcuffs that you tie yourself in when you build a portfolio on 1031 exchanges. But you still end up with way more assets at work in the marketplace, so it's not a terrible deal. Um, and then this plays into the overall strategy of buy, borrow, die. So if you haven't heard this term before, buy, borrow, die means you buy assets that generate real earnings and you borrow against them. So that's how you liquidate them is you don't sell, you just borrow. And because of the inflationary monetary system that we live in, those dollars become cheaper and cheaper to pay back over time. So um, just to take an extreme example, let's say like the house I'm living in right now, right? Um, right now it's worth about 400 grand. It's a pretty typical single family residential house. And the, you know, when it was built in 1963, it sold for, I don't know, 5,000 bucks, something like that. So, if you borrowed 100% of that 5,000 back in 1963, then that was a lot of money back then. But because inflation has eroded the purchasing power, you're able to pay that back in later dollars much easier than you are in current dollars. And if you can use leveraged money in current dollars and pay it back in inflated dollars over time, as long as the inflationary monetary system exists, that's going to work out for you. And it has existed since 1913 and has really taken off since 1971. So there's no indication whatsoever that this will change. So, and then you die, to be honest. And your heirs are able to inherit your property and they get what's called a step up in basis. So, step up in basis means that, I die and I leave my kids, a house, let's say, and you know if they turn around and sell it the same day that they inherit it, they pay $0 in tax. And the reason why is because their basis, their which is the net uh, investment that they have in the property for calculation of gain, is whatever the value is on the inheritance, on the date of the inheritance. So, today is October 1st, let's say October 2nd, I keel over, and um, the value that my kids have as inheritors is whatever the value is on October 2nd. And so if they sell it October 3rd, there's no there's no time for the asset to change in value, and so they have zero gain. Um, even if they wait 20 years and sell it, it's still going to be much better for their tax purposes to use the basis on the date they inherit it versus the date, whatever the value was when I bought it. So that step up in basis of asset transfer, still, it's not just real estate. It applies to stocks and all kinds of stuff. That step up in basis is the major way in which the middle class transfers value across generations, and mostly through real estate. So, well, I don't have time to go into a whole thing on how the Democrats are proposing to get rid of that or limit it, but it is something that's on the radar. Uh, yeah, so that's it's a bit more than 1031s, but yeah, these are the I say it depends. I try to
Right.
explain what it depends on. So we have a few minutes left, or we might have time for one more question.
Awesome. So we have a client that owns a e-commerce business, and they want to know how they ask, how do I determine if I need to collect sales tax from customers in different states or countries?
Here's the simple answer: you go talk to Avalara or you talk to Tax Jar, and they'll set you up. They'll get you straight. So what happened with sales tax, and this is not, we don't do sales tax, so we do income tax. But with that said, we obviously have to deal with companies that collect sales tax. So sales tax, in the internet age, for a long, long time, we had a moratorium on sales tax, meaning if you sold across state borders, nobody paid sales tax. Technically, they were supposed to pay use tax, but nobody did. So if I'm here in Georgia and I sold a widget to somebody in Florida, it's not a Georgia sale and it's not a Florida sale. So neither Georgia nor Florida were owed sales tax because it's interstate commerce, right? If I here in Georgia sold to somebody in Georgia, then it would be a Georgia sale and sales tax would be needed to be collected and submitted to the state. That all changed with the Wayfair decision. I'm going to say 2015-ish, somewhere around there. And Wayfair is the mail order company or the e-commerce company. And basically, they were taken to the Supreme Court, and the state, was it South Dakota? I don't know, one of those Western states. I'm blanking on which state it was off the top of my head, but they said, "Hey, you sold millions of dollars of stuff to our citizens. It doesn't matter that you're headquartered wherever. You owe us sales tax." And the Supreme Court agreed. So they created a new concept called economic nexus. So before you had physical nexus. So if you have a warehouse in a state or you had offices in a state, then that is a physical manifestation. It's a physical nexus in that state. And so if you're selling to people in that same state, then that's an internal state transaction and is subject to sales tax. But now there's economic nexus. And so uh, basically what happened is that 50 different states came up with 50 different sets of rules on what qualifies as economic nexus in the wake of this Wayfair Supreme Court decision. And so keeping up with that is a nightmare. So there are companies like TaxJar and like Avalara that will do this work for you and determine which states you meet the thresholds on, and then you have to register with the states. And there's thousands of different jurisdictions within the U.S. for different sales taxes because like a state might have a sales tax, and then a county might have a surtax, and then a city within the county might have an additional tax, and so it's just a patchwork nightmare of regulation. And so that's why these specialty operations have spun up, to handle all this stuff because this has been a problem for large companies forever, but now it's applying to small companies because of this, because of e-commerce and because of the Wayfair decision. So that's how you determine if you are if you are liable for collecting sales tax. You talk to the experts in those fields, and they will help you out. And they'll have software integrations with whatever your platform is to determine that. If you sell through something like Amazon, Amazon will do it for you, which is a benefit. But if you have your own e-commerce store and you're on Shopify or whatever, then you got to figure that out for yourself. And it's not so much the collecting that's the problem, it's the registration and filing that's the problem. Because if you have to file you know, 1,500 different jurisdictions quarterly, then that's 6,000 things you got to do a year. So it's a problem. Uh, so yeah, it's e-commerce is hard. No margins and lots of regulatory requirements. So personally, not a fan because you got to do enormous volume in order to make that all work. All right. I guess that wasn't an it depends. It's just a go talk to the experts kind of answer. But what they will say is it depends. All right. So we are at the end of the hour. So thanks everybody for coming out. I appreciate it. And what to do next? Register for our free course that's coming out. So go to taxsherpa.com/74-days, and that is the waiting list for our course that's coming out. And basically, what that is that's going to take you from I have an idea to make money, and that's going to get you through creating your entity, doing your tax setup, creating your bank accounts, implementing the first level of tax strategy, so that your first, let's call it 100K, is really tax advantaged as much as possible, depending on your particular circumstances. And it takes you soup to nuts through all that, and it's gonna be a huge value to people starting new businesses. If you have an existing business, it'll still help. You'll just skip the parts about formation and stuff. Um, and if you're doing well over 100K worth of profit, then this will be the basics, and you'll need to add on other stuff later to continue to optimize. But it's the it's a great resource for getting started. So I've already recorded all the videos and everything with it, and the marketing guys are putting together all the stuff. I keep thinking we're gonna have it next week, but here we are. It's been several weeks, but it's coming. I promise. So go check that out, and you just put in your email, and you'll be notified when the course is ready. Alrighty, that is it for this week. We'll do it all again next week, which I guess will be the 8th, next Tuesday at 6 p.m. Eastern, and bring your questions. All right. Catch you guys later.